one and the same. So I don't know whether there was some students who were able to watch any video of portfolio. Any video of portfolio. Is there any student who was able to watch any video on portfolio, and perhaps upon trying to do 1 or 2 questions on portfolio management, they were not able to do those questions? They bring them here, we tackle them. Remember, for this syllabus coverage from scratch, for us to be able to cover this syllabus here from scratch very fast, students have got to put in a little more efforts. I mean, we must combine our efforts to ensure that we finish. And how do we do this? We watch all the videos, and then we come straight to such kind of an arrangement here where we'll be able to say, Mwalimu, I did this question from this past paper and I was not able to figure it out. Could you kindly do it? Of course, myself, I've done all the questions. There is no question I don't know how to do. So what is the response of my students there? Were they able to watch portfolio videos?
Rose is saying yes.
Rose is saying yes. That's one student out of that class has about 40, yeah? 59.
So I'm saying yes.
Yes. So I want to assume that after you watched this particular video on portfolio management, you guys, out of curiosity, you must have gone out of your way to attempt some questions in the revision kit or some questions from your past papers. So is there any question that you guys were trying to attempt, I mean, which you are not able to do, which you would want Mwalimu to do here live? So perhaps as you think through the question that you would want to give your Mwalimu, I would want to take this opportunity to ask you a few questions. But no problem will be the typing speed, especially those of you who are using mobile phones. What is a portfolio? What is a portfolio? What is a portfolio? What is a portfolio? I'm giving you 1 minute. I would want to see whether there is anybody who will be able to remember. Will be able to remember and tell us what a portfolio is. What is a portfolio?
I haven't given the account friendly advice.
Oh, you have not been given the account, eh? What is the name of that student?
Kennedy Ogaga.
Kennedy Ogaga has not been given an account. If possible, Kennedy, just send me your email address. I set you up right now. Send me your email address, Kennedy, and the evidence that you paid. And the evidence that you paid. You know, we are accountants that we have to exercise controls. Meanwhile, I'm asking a very good question, especially to everyone, to even Summit students. Summit students have already done this topic. So I want to see whether there is any student who knows how to define what a portfolio is.
Saying collection of investment securities.
Collection of investments?
Securities with the name of minimizing the risk.
Very good. That is a good student. This great student of ours here, Leah, has told us that a portfolio is a combination of what here? Investment. A combination of assets. If, for example, today you were to win, you were to get like 10 million Kenya shillings. Chances are, if you are to get 10 million Kenya shillings, I know what most of us will do. Most of us will talk of, say, 20 million Kenya shillings. They'll say that all this money, you are better off putting up a big apartment with 3 floors. Very well, in this case here, for example, finished, right? And then 1 apartment, 2-bedroom the houses, each 2-bedroom the house, I'll be able to get like 30,000 rent. So you count number of houses like that. You take all this entire money, invest there. But now the moment you finish, that is when you realize that it's wrong for you to put all your eggs in one basket. A lesson that most of us in this case here are coming to learn, especially over this COVID-19 pandemic. It's wrong for you to invest, or rather to put all your eggs in one basket. After you're finished doing your apartment, that is when you get the major. Nowadays, you don't talk of Sonko. We have a major in town who is in charge of Nairobi Metropolitan Services, NMS. That is when you get that major coming with that thing, yeah, saying that you've built this house on a road reserve, and then you'll see all your 20 million getting into the drain and going like that. What if you are a bright person and went ahead and spread your risk? So some of these men, ladies and gentlemen, for example, went into a house. The houses are not bad, yeah, but don't take everything to apartments. Don't take everything to real estate. So 20 million, some of it like 5 million went in this case here to a house. Another 5 million, for example, to paper assets like if I'm the one, I would buy so many Safaricom shares, but not all of them, not for the entire. So Safaricom shares, some other amount in this case here went to something different. Such that should things not work, for example, here after some time, Safaricom is run down by greedy people, and of course my shares, for example, go down to zero, like how Uchumi shares are, or how KQ shares are. If they were to go down to zero, ladies and gentlemen, then I'll still be having some fallback positions, and that's why I like Leah's definition. She has told us that a portfolio is a collection of investments, many assets, which we combine together as investors with one objective. The objective being minimizing risk. Minimizing what here? Risk. Now, ladies and gentlemen, talk to us. How many types of business risks do we have? How many types of business risks do we have? We have two types of business risks. We have two types of business risks. We have what we call unsystematic, and then number two, we have what we call systematic risk. Systematic risk. I know I'm becoming more of a bother to you because of the gadgets. Typing using a phone is not an easy thing, but just bear with me. Kindly bear with me. I would want somebody to give me one statement describing each of these. What is unsystematic risk? What is systematic risk? And then I'll be able to tell you the difference. We have Auma. Auma gives us a very good definition. Auma tells us that systematic risk is that risk which is available in all the industries, in all the sectors. There is no way you'll be able to avoid systematic risk. From the word systematic, uniformly distributed what here? Risks. Uniformly distributed risks. These are those risks that are unavoidable. They exist all over. You can't avoid them. Of course, from that definition, ladies and gentlemen, will be able to define. Unsystematic risks are those risks that are industry specific or company specific. They affect specific companies. They don't cut across all companies. And as such, because they don't exist in all companies, I can easily run away from them as an investor by investing in those companies that do not have those kind of risks. So unsystematic fluctuates different between companies, and there are companies which are never affected by what here somebody unsystematic risk, by unsystematic risk. Now, ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. If an examiner asks me to describe the two types of risks, I will come and capture them in the form of what here, in the form of a graph like that. And then show my examiner that I've got this risk, which does not do what here, which does not reduce further as we increase the size of the portfolio. So this is what we call the systematic what here, the systematic risk. The other risk here is called what here on systematic, the one that reduces with time. The one that reduces with time. The one that reduces as the size of the portfolio grows. As the size of the portfolio grows like that. Now, ladies and gentlemen, for us, we are required to do very few things to understand this portfolio concept. We need very, very few things. Very, very few things. To understand the portfolio theory, you don't need so much. You don't need so much. You don't need so much. To understand the portfolio theory, so like we have this question, ladies and gentlemen, here, where they have given us probabilities. They have given us probabilities 0.2, 0.6, 0.2. They have given us returns on company X, in the form of percentage. We have 24, we have 12, we have 0. We have returns of Y in the form of percentage. We have 5, 30, and then we have -5. And then they are telling us that Betty Muye has invested 75% of our funds, 75% of her funds in X, and 25% in Y, and 25% in Y. So could you kindly, first of all, write up to there? Kindly write up to there first. Yeah, I can see very many students here gave us very good explanations. Here we have systematic risk is a risk that cannot be eliminated. Thank you very much. Lucy says the board is not clear. Please adjust the camera. Adjust the camera. Are there students, or rather, how many students are saying that the board is not clear? The board is not clear. How many students are saying the board is not clear? How many students can't see my board very well? Not clear, blurry. So not clear. Just check the camera. Check the camera. Not clear at all. It's very many of them. I zoom in. So Betty Muye has invested 75% of her funds in X and 25% in Y. And 25% in Y. Hapo, nasema hapo. Sawa sawa hapo sasa. So Betty Muye has invested 75% of her funds in X and 25% in Y. So now they want us to do a few things for them. Required, number one, they want us to give them expected returns. Expected returns of X and Y. Expected returns of X and Y. I also think my pen is not very good. We can get a pen. Very good. So expected returns of X and Y. Expected returns of X and Y. And I would want you to guide me to remember today I am your guest. Today I'm not your teacher. Today I am your guest. Given that all of us have done this topic, you've been able to watch the videos, yes. Apart from one gentleman called Ken, who was not able to get his login details. And of course, for the summit students, I do believe you have done this topic very well. So ours actually is to revise, and that is why I would even want you to write this at the back of your books. At the back of your books, at the back of your books, at the back of your books. So what do we have, ladies and gentlemen? What do we have, ladies and gentlemen? Expected returns, expected returns, expected returns. What do we do to be able to get expected returns? I'm waiting to read. I'm waiting to read the way forward, what you have as the way forward for getting expected returns. And you know, sometimes these things here could be very easy to the extent that defining them becomes very hard. Could be very easy. I mean, how do you this? Could be very easy to the extent that defining them becomes a very hard thing. Becomes a very hard thing. Okay. Okay. So to get expected returns, remember that our expected returns, we normally write expected returns like this. It is E, for example, our X. So this one we interpret it as expected returns of X. Expected returns of X. How do we get this? We'll take the actual returns of X and then we multiply this with the corresponding what here probabilities. We take the actual returns of X, multiply this with their corresponding probabilities. So come and sum like that. So come here and they give us expected returns of X. So we have 3 actual returns. So what I'll do is to take the actual returns given times their corresponding probabilities. So I'll talk of the actual return, the first one of X given is 24, times the probability here, which is 0.2. So it is either I get this 24 actually, or I get, or means I add. So or 12 times 0.6, 12 times 0.6 plus 0, 0 times 0.2. So could you kindly give me the answer here? Kindly give me the answer for expected returns of X. What do we have here, somebody? 12. Thank you, and thank you very much. That is number 1. Then using the same, on the same breath, could you kindly give me the expected returns of Y? Give me the expected returns of Y. What do we have there?
18.
18, because what they have done is to take 5 times 0.2 plus 30 times 0.6 plus minus 5 times 0.2, which they're able to give me an answer of what here, somebody? 18. 18. They're able to give me an answer of 18. That is Roman 1. And then now we go to Roman 2. Let's go to Roman 2. Roman 2, they want us to do something very easy. Roman 2, ladies and gentlemen, they want us to give them the deviations. And the Roman 2, they want us to give them the standard deviation of X and Y. The standard deviation of X and Y. So standard deviation of X and Y, I would want to beg of you, or rather from you, kindly give me the formula of standard deviation. Standard deviation equals what? Somebody give me the formula. Give me the formula of standard deviation. Give me the formula of standard deviation. What do we have there, somebody? Give me the formula of standard deviation. Give me the formula of standard deviation. Please help me. What do we have there? course, I know there is no way you will be able to write it very well, but I am so sure. You can even write, instead of saying square root symbol, you can say square root in words. Square root in words, square root in words. Tell us what we have there, somebody. I'm just waiting here to see the answers. Square root of Rx minus ERX squared times PI. That is Joyce Kangu. Probability, then square root. Thank you very much, Raymond. Thank you very much, Raymond. Someone else, this is a class of 74. I expect at least 10% to respond. I expect at least 10% to respond. So I expect at least 8 people to respond. From Raymond still, I'm waiting for the others to talk. Is there anybody else who has been able to try something there? Now, ladies and gentlemen, these are bright students. First of all, remember standard deviation symbol. We write the standard deviation symbol like this. You write a 0 and then you pull a tail. Don't write a standard deviation like you are writing a mitochondrion like that. That is very unprofessional. This is very unprofessional. To write standard deviation very well, you simply write like a 0 and then you pull a tail like that. So standard deviation of X, what do we have here? From the word deviation, we are looking at the actual return minus expected return. So we have here Rx minus ERX like that. That is the deviation we are talking about. But remember that our deviation is special. And that is why we are calling it standard. That's why we are calling it standard. So ladies and gentlemen, this deviation, for it to be standardized, we need to square it. And then remember, we need to come, ladies and gentlemen, and average it by multiplying it with the corresponding water probabilities. And then at the end of the day, you sum. Because the deviations are many. It can't be called a standard deviation if it doesn't have a square root. It cannot be called a standard deviation if it does not have a square root. So you must have a square root like that. So come and create a column here for Rx minus ERX with square times probability. So we have Rx minus ERX with square times probability. I'm following the formula here. So this Rx means actual returns. ERX is the expected returns because the deviation that we are talking about has to be the deviation between the actual and what are they expected. So I'll come here and write the actual returns very fast downwards. So we have 24, we have 12, we have 0, then we have minus, minus, minus. Who is able to remind us the expected returns that we got in part 1 up there? In part 1 up there, is there somebody who is able to remember the expected returns? Please talk to me tonight. 12. So we have here 12, 12, 12. Because the expected returns have to be the same. Expected is another term for X bar. X bar has got a bar meaning uniform. Uniform. So once I have these figures, what I need to do is to come and square each one of them, and then you come and multiply them with the corresponding probabilities. Multiply them with the corresponding probabilities. We have 0.2. The next one is 0.6. The last one is 0.2. Please give us figures. Please give us figures. So how do you give us figures? You'll come and open brackets. Tell us 24 minus 12. You square times 0.2. You square times 0.2. You square times 0.2. Please give us an answer. Please give us an answer. The first one, we have open brackets 24 minus 12 squared times 0.2. What figure are we getting, somebody?
28.8.
I'm being given 28. Is this figure coming from many students or only one student?
So, 4 of them.
4. I'm left with 3. 3 students to get it for me to know that my sample is okay. Thank you very much. Same. So come to the second one. The second one, I'll say simply in my brackets there, my calculator there, 12 minus 12 close squared times 0.6. Times 0.6, please give us a figure. 0, eh? The second one is 0. And then the last one will be open brackets again, 0 minus 12, whatever we get to square, times 0.2. What figure are we getting there, ladies and gentlemen?
28.8.
28.8. Remember what I normally see students, the mistake I normally see students doing, you get them saying each one of them. On top of each one of them, they put a square, forgetting that this square root is coming after summation. Once I have those deviations that are squared and of course compared with their corresponding probabilities, once I have them, what I need to do is to come and sum them. We sum them. When you sum them, kindly advise me what figure are we getting there. Kindly advise me, and then you tell me the figure that you're getting here.
57.6.
57.6. So this 57.6 is our total variance. This is our total variance. And therefore, for us to get standard deviation, I will come and talk of square root of 57.6, which will end up giving me what figure, my great students?
7.59.
7.59, thank you and thank you very much. 7.59, thank you and thank you very much. 7.59, thank you and thank you very much. Remember, they want us to give them standard deviations of the two securities. We are through with the X, now we go to Y. So come and give us the standard deviation of Y. Once I hear the word standard deviation, really, I can't be defeated at all. To remember, I can't fail to remember the formula because of the word deviation. Deviation means subtraction. So subtraction, what do we have here, somebody? We have the difference between actual returns of Y and expected returns of Y. It's a special standard deviation, so the returns, the differences must be squared times the corresponding what-year probabilities. And because there are many, we must sum them. And of course, it can't be called a standard deviation without what-year, a square. So please get space either here or anywhere and create a working for this. Create a working for this, and then you advise us accordingly. You advise us accordingly. Advise us accordingly. Advise us accordingly. Okay, ladies and gentlemen, let's see what they have here. So the actual returns of y are here. So we have 5, 30, minus 5, minus. Expected returns of y, what figure do we get for expected dividend of, well, the expected returns of y were 18. So 18, 18, 18. And then, ladies and gentlemen, these ones, they will be done, what they will be squared. Times the probabilities. What do we have here as probabilities? We have 0.2. 0.6 and 0.2. So could you kindly give me the figures here very fast? Kindly give me the figures very fast so they can be together on the same page. On the same page. On the same page. The first, especially the figure that I'm interested in is the figure that comes here, the one of total variance. Somebody give me the total variance. I'm not even interested in the others. Please, if you have the three, add them up, give me the total variance figure. Give me the total variance figure. Are you able to see the total variance figure?
226.
226. I'm being told it is 226. And therefore, our standard deviation will be the square root of 226, which at the end of the day will give us, they are given as the answer up there. Which at the end of the day will give us what figure?
15.03%.
15.03. I can decide to omit the percentages. Yeah, 15.03. Thank you and thank you very much. 15.03. Thank you and thank you very much. Now, you guys, I want you to do me a favor. At least standard deviations, I'm so sure now we are very comfortable with that. We are very comfortable with that. So I would want you to give me, number 3, I want you to give me the formula of covariance. Covariance between two securities. Covariance between two securities. So give me the covariance between X and Y. A good student, first of all, must comprehend the meaning of the word covariance. What is covariance? What is covariance? Ladies and gentlemen, covariance stands for the shared variance. Covariance is the shared variance. When you hear of this word common, shared, anyway, you hear of the word common. Like if somebody is saying co-wife. Yes. Yes. So please come and give us this covariance thing. When they want me to give them the covariance thing, ladies and gentlemen, I know the formula. I know that this one here will be deviation of X. Deviation of X, because there are two people here. Multiply this by deviation of Y. Deviation of Y. At the end of the day, I will come and talk of probability. Probability, and then I sum. Remember, in covariances, there is nothing like squaring, nothing like squaring, nothing. So covariance, there are two things sharing some commonality, sharing some variance. Covariance is a shared variance. Shared variance, two securities having the same variance. So then how do you get, ladies and gentlemen, the covariance between the two? You will take the deviation of X, you multiply this with the deviation of what here? Y. And how do we get this deviation of X? To get the deviation of X, we normally take Rx minus ERX. Come and multiply this with the deviation of Y. Division of Y, we have Ry minus ERY. Times probability, you put the probability, and then at the end of the day, you do what here? You sum there. You come and sum there. Please write up to there, write up to there, write up to there, right up to there, right up to there. So we have the actual returns of X. Actual returns of X are 24. We have 24, we have 12, we have 0. The only thing that I've forgotten is what we had up there as expected returns of X. Expected returns of X, you guys need to remind me, what figures do we have there for expected return of X?
12.
12. They're giving me a figure of 12. They're giving me a figure of 12. So I'll talk of 12, because expected returns don't keep on fluctuating. So go to actual returns of Y, the ones which were given here. The ones which were given here, we had 530 and minus 5. So we have here 530 and minus 5, minus. Do we have our expected returns of Y? Yes. We're given expected return of Y, which is 18. Ladies and gentlemen, come and multiply these ones here with what here their corresponding probabilities. Multiply them with their corresponding probabilities, which are the first one is 0.2, the second one is 0.6, the third one is 0.2. So please give us answers. Please give us answers. Please give us answers. Please give us answers. So like the first one will be brackets 24 minus 12, close brackets, times, there's an in between here, there's a times in between here, times open brackets, 5 minus 18, close brackets, times 0.2, and then you give me an answer I put down. Give me an answer, I put it down. Give me an answer, I put it down. What is the name of that student who is really helping us? Many of them. Thank you very much. So negative 31.2. Negative 31.2. The second one, of course, this being a 0, the second one will be what there? Will be 0. The second one will be 0 there. The second one will be 0 there. How about the third one? How about the third one? So the third one, please open bracket, 0 minus 12 close, times open another bracket, minus 5 minus 18 close, times 0.2. Please give us an answer. 55.2. So come and add together. Add together to give us the total covariance. Add them together for you to give us the total covariance. So total covariance, I'm being given a figure of 24. The total covariance, I'm being given a figure of 24. A figure of 24. A figure of 24. Thank you and thank you very much. Thank you and thank you very much. So that is how we normally compute the covariance. Covariance. Now the next thing that I would expect you great students of mine to give me, the next thing will be the coefficient of correlation. The coefficient of correlation. We can call it RXY. Coefficient of correlation. R is the correlation. You can have it. Doesn't matter. But the proper one is R. The coefficient of correlation between X and Y. For those of you who watched the video so seriously, could you kindly give me the formula for getting R between X and Y? R between X and Y. What do we have there? R between X and Y. What do we have there? R between X and Y. What do we have there? Someone talk to me. 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 I'm waiting for you to talk to me.
Raymond is saying C or this drop.
Very good.
X.
That is a great student. That great student is telling us that, ladies and gentlemen, for us to be able to get the correlation, now the correlation between two securities, you basically standardize the covariance. So you take the covariance between the two, and then you divide them by the respective standard deviations. So correlation is the standardized covariance. Correlation is the standardized covariance. And the covariance that you guys gave me down there was 24. All over the standard deviations that unfortunately I deleted mine. Mine in this case here, we have the I rubbed mine long time ago, but I know you guys have the figures. I know you guys have the figures. I know you guys have the figures. What is the standard deviation of X? 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 Yeah, 7.59, right? And Y 15.03. So we have here, we have, ladies and gentlemen, the 1 over X, the 1 of X is 7.59. 7.59 times the 1 of Y, which is 15.03. Times the 1 of Y, which is 15.03. Thank you and thank you very much. So remember, these are supposed to be combined. So could you kindly take 24 divided by, open bracket, 7.59 times 1, 15.03, close brackets. Tell us what we are able to get there. So you say 24 divided by open brackets, 7.59 times 3.03 close. What figures are we able to get there? Yeah, somebody tells me 0.21 is the correlation coefficient between the two. So this is equivalent to 21%, quite a low relationship. The two securities are not strongly related. They're not strongly related. 21% is below 50%, which signifies a weak relationship. Which signifies a weak relationship. Thank you and thank you very much. I think you're progressing well. Ladies and gentlemen, the next thing that I would expect you to do for me, the next thing to expect you to do for me is number 5. They want us to give them Betty Muyer's portfolio, expected return. Expected return. Betty Muyer's portfolio, expected return. Remember, this lady called Betty Muyer is a wise lady. She said that there is no way she could have put all her eggs in one basket. No. So she went for 75% of X, and the balance, which is 25%, put it in Y. So then what will be her expected return of the portfolio? The expected return of the portfolio, ladies and gentlemen, will be equal to who? So expected return of a portfolio. Remember from the word go, there is somebody who told us that a portfolio is a combination. So we want to see who has this correctly. A portfolio is supposed to be a combination. It's supposed to be a combination. Now, a good student is asking us a great question there. What would have happened if the examiner wanted us to get coefficient of what here? Variation. So how do we get coefficient of variation? Remember, coefficient of variation is basically, that's how you remember it. It's basically sex in what here? In percentage. Sex in percentage, where my sex is weather, gender. So meaning that CV will be equal to standard deviation over the mean. So remember, standard deviation is like this. Mean is our expected returns. So if it is CV, what they can do is to ask you to get CV of X. Well, we'll take the standard deviation of x divided by the expected return of x. They can ask you to get CV of y, the same. They can as well ask you to get CV of the portfolio, where you take the standard deviation of the portfolio divided by expected returns on the portfolio. I hope I've answered your question. Thank you very much. I can see very great students here like Ronald Masigeshoi, Catherine Angelar, giving us very great, even Lucy Njue. Yeah, giving us formulas which will help us to get, ladies and gentlemen, expected return. Whenever I hear of expected returns of a portfolio, this basically is the weighted average of returns, weighted average returns. Weighted average returns, yes. So my expected returns of my portfolio in this particular case will be equal to weight of x multiplied by expected return of x plus weight of y multiplied by expected returns of y. That's how you remember this. Because a portfolio is a combination, you're combining everything. But of course, as I combine those returns like that, it has to be clear in my mind that I never invested in X 100%. I only took a proportion. The proportion is what we are calling the weight. The proportion is what we are calling the weight. So the weight of X, remember, weight must be point something. You can ignore all the percentages, but weight must always be point something. They told us X, they're investing 75%. So weight of X is 0.75 times the expected returns of X. You guys gave me a figure of 12 plus weight of Y. Weight of Y is 0.25 times the expected returns of Y. Expected returns of Y, ladies and gentlemen, expected returns of Y. You guys have given me a figure of 18. So could you kindly give me the final answer here for expected returns of the portfolio? ERP. ERP is expected returns of the portfolio. That I can see so many students giving me a figure of 13.5. A figure of 13.5. A figure of 13.5. A figure of 13.5. Now, ladies and gentlemen, we are progressing on very well. Now I need to get into the last thing, which happens to be the icing on the cake, what we normally call the rubber meeting the road point, where you'll be able to ascertain between those students now who are very good and the students who are good, but they don't want to put in enough effort. The last one is the standard deviation of the portfolio. So I think it's number 6. Standard deviation of the portfolio. Standard deviation of the portfolio. This is how we write it. I would want to see whether there is any student who will be able to remember the formula of standard deviation of the portfolio. 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 So let's see whether they have a formula. Ah, great. I can see Raymond really trying. Great. Great. Even Joyce, yes. George Getao, thank you very much. You have even been able to see that big square root. Yeah, that's quite innovative. Francisca has told us weighted average, but now weighted average of what? Weighted average of what? Thank you very much, Jadida. That's quite wonderful. She's been able to remember that formula very well. Very well, very well. I'm waiting for one more person to try. One more person to try. To try. Mercy, thank you very much, Mercy. Thank you very much. Men, even Bianca. Bianca, great to see you here. Great, great, great. Great. So what they're telling me is that to get the standard deviation of the portfolio, this is quite complicated, a little bit, not too much, but a little bit. Standard deviation of the portfolio, ladies and gentlemen, most of them have been able to remember. It's supposed to be weight of X, standard deviation of X, plus weight of Y, standard deviation of Y. And that is why you saw some students saying that the standard deviation of the portfolio is a weighted. But now remember the proper thing, that standard deviations ordinarily, they are never supposed to be added. Whenever you give a standard deviation, you're supposed to come and change them to variance, and you square everything in that term. So this is the variance of X, this is the variance of Y. Now you need to come and talk of twice. You introduce the common variance. Twice the covariance between X and Y multiplied by what here? Of course, the others have weight. So you must introduce the weight of X, you must introduce the weight of Y. So then at the end of the day, at the end of it all, you put a square root like that. The moment I understand the standard deviation of a portfolio, how to compute it, then straight away, I will have mastered the entire concept. I will have mastered the entire concept. I will have mastered the entire concept here of portfolio management. Portfolio management. Now, ladies and gentlemen, please come and plug in the figures. We have square root of the weight, I know it's 0.75. 0.75 times the standard deviation, I think this is the one that you gave me, is 7.59. Plus 0.25 for Y times 3.03. So these ones must be squared. Plus twice the covariance. Covariance between X and Y, if I'm not wrong, we may have gotten 24. Who can remind us the covariance between X and Y? Let me not rely on my memory so much. They're telling me that the standard deviation of X is supposed to be 7.45. So Lucy Nyamu tells me for sure covariance is 24. The covariance is 24. How about, ladies and gentlemen, 24. So times 24 times 24 times the weight of X, 0.75, times the weight of Y, which is 0.25, like that. Which at the end of the day, if I'm not wrong, I'm able to see somebody giving me a figure like 7.45. And again, remember that these things don't need somebody who is fearful. Somebody who fears things. No. If I'm the one doing this, I'll come and punch all these things in the calculator, lump them together, and then I say square one off. Even if I get it wrong, so what? After all, CAPM is not about accuracy. CAPM is about the methodology. the state. Because the more you fear, whatever you fear will always come to pass. Whatever you fear, including these students who normally fail this paper like 4 or 5 times, because you are really fearing this paper. You are really fearing it. You are fearing it. Like juzi, nilikuwa invigilator kule KU. Nikapata mzee rika yangu over 40 years. Mzee ako na heshima zake na kitambi. Right? Sasa mzee, mimi napatia makaratasi namna hii. Nilikuwa mle sample a center. So kupatia mzee karatasi, sijui ni harufu ya AFM paper ama ni kala, ikaanza na kalamu kuanguka chini. Kalamu zote chini. Normally, I like my students. I mean, that kind of a thing, whenever it happens, even when I'm teaching, na kuokotea, sana kuokotea, nikampatia. Kumpatia namna hii, calculator chini. Nikamwekea. Kuangalia mzee, jasho. Nauliza mzee namna gani, nikamtoa nje kumcancel kidogo at least. Namna gani akaniambia pipa nimerudia mpaka nikiona mimi mwili naharibika kabisa. Nikampatia siri moja, nikamwambia hakuna kitu kama lazima upite. In this life there is nothing like a must. You just go and put in your best foot forward. Right? Try your best. And just assume like you're doing any usual, like how you do your CATs, continuous assessment test. Just go and do it. Once you relax like that, you'll be able to, of course, write so many things, because you're not doing it under duress, under pressure. Right? So I could see the guy went back, akaandika vizuri. Fortunately, I got to know him. When the exams were out, this gentleman had passed. I'm so sure if it was not for the word that I told him, of course I told him, I went ahead even to tell him that you don't have to pass this paper. I mean, it's not a matter of life or death. So take life easy. Were it not for that encouragement, that gentleman would not have passed with the kind of pressure he was under. So most of us really get to fail in some of these papers here because we fear them. Unakuta mtu skuli ya mtihani hata akitoka kwa nyumba anatetemeka. Ni kama unaenda hakuna kitu. These are normal things. These are very, very normal things. Take them to be as normal as they are, and you can never fail them. Because there are things, ladies and gentlemen, like the theory. Like now the other time, we got an examiner who was asking us about what here? Functions of World Bank. So you get somebody who is under a lot of pressure. Somebody who says that I have to, or rather if I don't pass in this paper, I'll die. Some of those small points will not be able to come from your head easily. Because World Bank, just like any other bank, ladies and gentlemen, they're in the business of doing what their major business is to offer loans to member countries, isn't it? How do you forget that? You can only forget that if you say, I must pass. If you say you must pass, and then you go and get a bad examiner like myself, who will harass you, especially for the first 2 questions. Naika swali ya kwanza, unasoma, ukisoma unashangaa hii ni home science, ni geography, yani swali haina mbele wala nyuma, ni swali ya advanced financial management. So for you to be able to know that the 3rd, the 4th, and 5th questions are doable, you must be a courageous person. You must be a courageous person. Ni kitu ya kusweat, unatoa jasho kwa hapa. Unafikiria ni banaya. Hiyo kitu haita kupeleka mahali popote, utaanguka. So we must be very courageous. So what figure are we getting at the end of the day as the standard deviation of our portfolio? So they're getting 7.45. I don't know where Mass is getting 7.47 from. Most of them are getting 7.45. So we have Rose saying, I like how Mwalimu encourages us. Yes. So 7.45. AFM wanafunzi wengi wanaanguka, not because wanafunzi wajinga, hapana, nimefunza wanafunzi wengi sana. Wanafunzi wanajua hizi vitu. Lakini anaanguka sababu ya uoga. Uoga inakuwa mingi. So hapana kuogopa sana. Hata mama anapata mtoto bahati mbaya, anafariki, hautasema uziko na mtoto hapo, hapana. Maisha lazima yaendelee. As much as it looks bad, maisha lazima yaendelee. So courage is the most important thing. Now, ladies and gentlemen, write for us there the portfolio equation. Hata kwa darasa, wanafunzi wengi hawaelewi sababu wanafunzi wengi wanajaribu kuchunga sana. Hata kuonekana ni mjinga. No. Mwanafunzi mzuri unafunguka roho, unazungumza unachotaka kusema. The more you talk, like now we are talking through comments, just keep on commenting. How do you comment wrong? So what? There's nothing really. So like now here, can someone write for me the portfolio equation? Remember in AFM, there's nobody who will tell you to derive it. Kindly write for me the portfolio equation. Write for me the portfolio equation. Write for me the portfolio equation. What do we have there? Somebody portfolio equation. Yeah, Jaira says Team Courage, yes. Panaogopa mambo sana. I want to see whether there is anybody who will be able to write the portfolio equation. Just write something there. If you're not able to get anything, just write. Even if you write your name, that is the kind of courage you want. People keep on writing, keep on talking. Because if you don't do that, for sure, you will sleep. Yeah, Catherine Nanjala has really done a good job. A good job, I tell you. I can see from a lady called Catherine Nanjala. Catherine Nanjala. Peter Kinyumu, a good job. George Gitao, ERP minus actual. No. George Gitao, what you are getting is what we call the Jensen's alpha value, the profitability index. But I like the fact that you have tried writing down. There must be somebody somewhere who is playing very safe. In life, never play very safe. Never play very safe. Be yourself. Just say. I'm waiting for about 4 people. Nduga, my friend. Yes, Nduga, this is correct. Thank you very much. Thank you very much. Thank you very much. I'm waiting for 2 more. Only 2 people. 2 more. The portfolio equation is quite similar to the CAPM equation. It's quite similar to the CAPM equation. At least user faith has known that we must start with risk-free. You can see she has only written RF. That's what we like. A student who comes out and says that I may have forgotten every other thing, but I know these equations must always start with risk-free. We have Ruman, what we are giving us there is the portfolio, expected returns of the portfolio, not the portfolio. Portfolio equation is a special equation. Virginia wanted to write something, but I can see you've tried, but we were not able to finish. For standard deviation, you can decide to use D. We have Diana. Diana has also really tried. Yeah, thank you very much. So here we are. Ladies and gentlemen, the portfolio equation. We have returns of a portfolio being equal to the portfolio equation, returns of a portfolio, ladies and gentlemen, equals, we must always begin with risk-free, because risk-free is the smallest possible return, which is normally guaranteed. And then from there we go to the returns of the market, the premium basically. So we talk of the expected returns of the market minus risk-free, multiplied by the standard deviation of the portfolio all over the standard deviation of the market. This is something that I would want you guys to write, and if possible, you block it like that. Please highlight. It's called the portfolio equation, where you take the risk-free plus what we call the risk premium. Because when you go to invest in securities which are trading in the market, there are chances you may lose. there are chances you may gain. So we call it a risk premium. This one here. This one over here is called risk premium. This one is called risk what here? Risk premium. And because it's a risk premium, we must come and attach this to the risk factors. Remember, risk is normally measured using standard deviation. Risk is normally measured using the standard deviation. So this is what we call the portfolio equation. And because we are revising, I can also take this opportunity to just show you how we also write the CAPM equation. The CAPM equation. So CAPM equation, ladies and gentlemen, what do we have here? CAPM equation, what do we have here? We have what we call the CAPM, returns of a security. The same thing, we have risk-free plus ERM minus risk-free. But remember, under CAPM, we normally measure under CAPM, we normally measure our risk using beta factors. So you put there beta of a security or over beta of the market. You can also say beta of a portfolio. But now remember, under CAPM, and that is why we normally call it a security market line. Security market line. Under CAPM, we prefer talking of returns of a security. Although if you were to put RP and here BP, no problem. No problem. No problem at all. No problem at all. So one thing you're supposed to remember very fast as you write CAPM equation is that for CAPM, beta of the market is always equal to what? Beta of the market is always equal to 1. Beta of the market is always equal to 1. And that is why CAPM returns, ladies and gentlemen, do not have that beta there. Because beta of the market is always 1. CAPM returns, we have risk-free plus expected returns of the market, minus risk-free into beta of a security, into beta of a security, into beta of what here? A security, into beta of 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 a security. Now let's get back here with an exercise. So we have an exercise, ladies and gentlemen. These people have given us portfolios. Portfolios, we have A, B, C, and then we have M. They have given us expected returns in form of percentages. So A is 10, B is 11, C is 8, the market, ladies and gentlemen, is 9. 9 like that. And then they have given us the standard deviations of the portfolios. This could be ERP, percentage. So standard deviation, this is 5, this is 3, this is 2. Ladies and gentlemen, standard deviation of the market happens to be 4. And then now we have additional information. Additional information. We have additional information. So additional information, ladies and gentlemen, additional information. What do we have here? Additional information. They have only given us the risk-free rate of return is 6%. The risk-free rate of return is 6%. So required, number one, required, Roman 1, the required rate of return of portfolios. Required rate of return, ladies and gentlemen, here, you have to use the portfolio equation. You must use portfolio equation. And then number 2, ladies and gentlemen, We are given here, use portfolio equation, the number 2, they want us to evaluate the efficiency, evaluate the efficiency of the portfolios. Evaluate the efficiency of the portfolios using the Jensen's alpha model. 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 So team courage, team courage, team courage, team courage. Team courage. I would want you to give me the required return of the required rate of return of the portfolios. Of the portfolios. What do we have there? Catherine Angela has been able to get 9.75 for A, I suppose. For A, according to Catherine Angela, we have 9.75. How about from the other students? From the other students, what are we able to see there? So they're telling me 9.75 for A, Bianca 8.25, I don't know for which one. A, Veronica 9.75, B 8.25, and then C 7.5. Thank you very much, thank you very much. Thank you very much, thank you very much. I can see team courage now. People are courageous. People are very courageous. So, ladies and gentlemen, here we are. Here we are. Let's see. So, we are saying that our portfolio returns according to the equation that we have. Our portfolio returns, our portfolio returns, our portfolio returns, our portfolio returns, our portfolio returns will be equal to, we start with risk-free plus ERM minus risk-free multiplied by standard deviation of the portfolio all over standard deviation of the market. So we start with A. So the risk-free rate of return is 6. Plus the market returns, this M stands for market. No one will tell you that. M stands for market, and I consider the market returns are what here? They are 9. Minus risk-free, which is 6. Multiply outside here with the standard deviation of the portfolio. In the question, the standard deviation of the portfolio is 5. 5 all over the standard deviation of the market. Standard deviation of the market is here, which is 4. I know the biggest mistake you always get over 50% of the students telling you, Mali will put 10 here. Mali will put 10 here. Why? Because this is A. And A, the expected return of A is 10. No. Look at what we have in the equation. All the portfolios, even B, this risk-free does not keep on changing. Neither does the market return. For any security, that will be the same. So minus, in this case here, 6. What will change is the risk profile. Like now here for B, the standard deviation of B, is 3. So this is 3 divided by 4. So could you kindly give me these figures very fast? Let's see what you guys have. Let's see what you guys have. Let's see what you guys have. What we have there. 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 So the first one from the student who is able to, Catherine gives us 7.5. Catherine gives us 7.5 here for A. How about B? Someone had gotten the 1 of B. Someone had gotten the 1 of B. B, oh, they're different. They are different. They are different. There is someone telling me A is 9.25. 9.25 is A. 9.25 is A. And then B is 7.5. How about C? How about C? C, what are they able to get? C, they are able to get. B is 8.25, I'm being told. B is 8.25. B is 8.25. And then C is the one that is 7.5. Now, having gotten, ladies and gentlemen, these actual returns of my portfolio, the next thing, of course, they want me to do is to evaluate the efficiency. Remember, there are 3 levels of efficiency. For portfolio management, there are 3 levels of efficiency. There are 3 levels of efficiency. The 3 levels of efficiency are defined by the alpha. So when alpha is positive, we normally say that the security or the portfolio is super efficient. Whenever alpha is positive, that means a profitable security. When alpha is positive, that is super efficient. Now, ladies and gentlemen, when alpha is negative, meaning that we are talking of a loss-making security, then this becomes what here, somebody inefficient. And then, of course, when alpha equals 0, we just talk of what here, the model being just efficient enough in predictions. So you've got 3 levels of efficiency. We have super efficiency when our security is profitable. It's called super efficiency. So I would want you guys to come and write the formula of the alpha. Alpha is the profitability index, the profit. So profit, I will look at the expected return. For the profit, I will look at the expected return. So for the profit, I will look at the expected return. So the formula for getting this alpha, which I can't write on the other side of the board because of my static camera. So my alpha, ladies and gentlemen, my alpha of a security will be equal to expected return over the portfolio, talk of portfolio. Alpha of a portfolio will be equal to expected return over a portfolio minus, in this case here, the required returns. Minus the required returns. Returns given by the portfolio equation. So like now for A, I know the expected return of A is 10. So it is 10 minus the required return of A, which you guys gave me a figure of 9.75, which will end up giving me a profit of 0.25. It doesn't matter how small that profit is, so long as it's a profitable security, then this automatically will be called what is about the super efficient. So A is super efficient. A is super efficient. Go to B. B, what do we have? We have expected return of B, which is 11. So 11 minus the required returns as provided by the portfolio equation. And then you gave me a figure of 8.25 if I'm not wrong. So somebody, what is the alpha of B? What is the alpha of B? What is the alpha of B? So from Veronica, we are being given a figure, even Mercy, 2.75. If I were you, I would have written there 2.75, and then I say super efficient. So long as it's profitable, that's what I tell my examiner. This thing is super efficient. This thing is super efficient. This thing is super efficient. How about C lastly? C, what do we have there, somebody? C, you will take 8 minus whatever you have obtained there as the required return. C is 0.5, which is what you're super efficient. Super efficient. So fortunately, all our securities that we have, ladies and gentlemen, here are super efficient. And whenever you have all your securities being super efficient, it means that you should not change the composition of that portfolio. If, for example, the portfolio had ABC, and you're getting that these securities ABC, all of them are super what? Super efficient, then don't change. 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 Do not change the composition of the security. Now, ladies and gentlemen, if I'm the one who is teaching you this, I'll straight away take you to CAPM. No, CAPM is quite key. And then we have what we call the arbitrage pricing models. Arbitrage pricing models. And then, of course, now gather their assumptions. You're through with the topic. But remember, you can only be through with this topic if you are an avid viewer of my videos. So those videos which are there, and you purchase those videos very expensively, actually. Although it's very fair. It's very fair. So I can't say it's expensive. I sold you the videos per subject how much? 3,400. 3,400. I sold you these videos of AFM at 3,400. This 3,400 gives you what? Number one, a revision kit. Which I want to assume that all of you got revision kits, the ones who paid this revision kits, must have gotten. And then number two, you are getting access to all those pre-recorded videos. Pre-recorded videos, like if you are keen enough, I'm still coming back to each topic. In each and every topic, I'm introducing the videos of the revision videos at the end of each topic. First couple of questions, I'm still introducing. Always be checking. So we have pre-recorded videos. And then we have these live classes for free, imagine. And then most importantly is that within these, you're still getting the block release content. The block release content will also be annexed there. So you can see it's a very fair thing. But unfortunately, you invest this amount, and then at the end of the day, you come here without having watched any video. So it becomes what here? Disastrous. It becomes disastrous. Like now, out of my entire class, which has paid for these pre-recorded videos of about 40, it's only 2 ladies who told us that we got time to watch portfolio management. Perhaps some of you came in a little bit late and they had watched the portfolio management videos. How many can confirm to us they had watched those portfolio management videos? How many? How many? Who came in a little bit late, but they're saying, Mwalimu asked, we had watched the portfolio videos. Because you see, given that you never watched the portfolio videos, now I've been forced to detour. Do what I never expected to do today. Because today I was simply to come here and then I get past paper questions from you, great students of mine, telling me, Mwalimu will stop all those things. Don't even introduce the topic. because the introduction was done in the videos. Just come here and do this question, this question, this question. Or even give us a test, something different. Something, because whatever I'm teaching here today is in those videos. How many? Let me see in the comments. How many were able to watch the videos? Jeta says she watched. Mwingine anasema mimi nilifukuziwa school fees. Yes, the ones who paid 1,700, we can't give you access to the videos, honestly, because also we're not giving you videos partially. We're giving you full, all the videos, so it's upon you to complete your fees first. I told you we must be good in controls. We must be good in controls. Okay. So I'm trying, I will. So we have Jana saying I'll pay, that's okay. Watch, but only a single video and a portfolio. You know, I have so many of them. I'll ensure that I put them there. Okay. It was only one which I watched. Mercy, thank you very much. I have so many of them. I'll ensure before I sleep today, you guys will be having all the videos of portfolio, all of them, all of them. So Sir Kennedy says I paid 2,000. Sir Kennedy, you have to complete paying school fees, eh? Otherwise, we shall not connect you, Sir Kennedy. Even if you have sent me your email address, I can't do that. We want to leave businesses behind as our legacy, so we have to really adhere to the rules and regulations. Here, AFR, mta upload link. Tume upload already leo. You see, like Teresa George says, she did not even know she was entitled for block lessons. Yes, we are very fair. And that is why I'm really moved with all those students who have said Mwalimu because of the new, you know, we are starting the new syllabus. The new syllabus will be starting when? In May 2021. New syllabus. The first exam of the new syllabus will be here. And normally what I encourage my students to do over the years is to ensure that you finish this thing before the new syllabus comes in. Like this time around, we have introduced fundamental changes. We'll not even be talking of CPA section 1, section 2. No, fundamental changes, because we want to realign the professional qualification with the academic qualifications here. We don't want a situation where you clear your CP and then someone tells you in a university like University of Nairobi, you'll only be exempted from 4 units. Even where I teach at Daystar, you'll come over there, we'll exempt you few papers, and then at the end of the day, like there's a paper I teach called Accounting for Equity and Liabilities. You start again telling this CPAK, that whenever you have, like now what we call payouts, whenever you have got purchases, expenses, assets, debit them. That if you acquire a motor vehicle, it's an asset, debit, right? If it's revenue, liability, share capital, credit, when they increase. So you can imagine I start again teaching these great students of ours, CPAKs, teaching them double entry. I mean, we don't want that. We want this syllabus here to be aligned, everything be aligned with it, so that when you finish part 1, you have a diploma. Part 2, you do, of course, in this case here, like a project at KCA University. You should be given, in this case, straight away a degree. Part 3, especially for the ones who are working for the civil service, you know that CPA Part 3 is normally taken at master's level. So you need to only do like projects, 2 or 3 projects here, thesis. You get to know the referencing skills here and there, the project writing skills, and then you have your degree. You have your master's, etc. It is just like ACCA. You see, once you do ACCA, ACCA has got 2 levels. We have the fundamental, and then we have the professional. Once you finish the first 9 papers of fundamental, ACCA has made arrangements with the Oxford Brookes University for their students to only write a research paper to get straight a degree, a Bachelor of Science in Applied Accounting. Once you clear your professional papers, which are 4 under ACCA, that makes you a chartered accountant. You only do 2 papers, thesis papers, at the University of London for you to get a master's. for you to get a master's. And this is a road that I followed myself. I followed this road of STCA and I can't regret. Like that. That is what you want to do with CP. Of course, unfortunately, now what will happen given the fundamental changes in the syllabus is that automatically once you do like AFR, for instance, and you fail, and then now here we are, May 2021 has hit you up. What will happen is that you will repeat all the papers in that section. And then, of course, you know, under the new syllabus, they want you to be very good in advanced Excel, practically. So as you will be repeating section 6, all the papers, will also require you to undertake some paper which will be in CPA part 2, the analytics paper. So the very best thing is to ensure that you clear. Those skills are good, but you can learn them much later. Clear your syllabus, all those things who are doing simplify. Clear your syllabus with this corona confusion. Okay, so that is it. So for those of you who have got energy, and of course with this corona confusion, you should be able to clear this part before then. And our prayers are that they give us our 2 sittings for this year. You know, this year we had the 2 sittings, which would have really become handy for our students to clear their CPAs before the 2021 May. So we had the May sitting. So you believe we'll do these exams in September. And then they give us another sitting, say in January, the 1 of November. We pushed forward to January around there before they give us a new sitting of May 2021. Otherwise, of course, we shall go outside there and protest, isn't it? If they only give us 2 sittings in between, 2 sittings of this, even if it's next year, they have to give us our 2 sittings. So please, for those of you who have decided to combine, no problem, ensure that you take maximum advantage of those videos. Take maximum advantage of those videos. You can even be watching like one before you sleep, like today after this class, you simply watch one before you sleep. Watch one before you sleep. So mention there, CAPM. CAPM in full stands for capital assets, pricing model, and I have to see whether there's anybody who is asking a question before I proceed. How I wish I met you at Daystar University. Yeah, Valley Road. Been there for some time. BCom undergraduates are very flat course. No wonder. Jaras Aki, thanks Mwalimu. Yes, 2 sittings, our 2 sittings. We'll have to demand we be given our 2 sittings. That is okay. Great. So overall, we shall do what here? We shall overcome. So remember, ladies and gentlemen, CAPM assumes what? CAPM assumes that investors are extremely risk averse, i.e., they hold on to fully diversified portfolios. They hold on to fully diversified portfolios. They hold on to fully diversified portfolios. A portfolio is said to be fully diversified if it does not have unsystematic risk. A portfolio, writing that a portfolio is said to be fully diversified. A portfolio is said to be fully diversified if it doesn't have any unsystematic risk. If it doesn't have any unsystematic risk. In short, we are saying that fully diversified portfolios are only affected by the unavoidable, unavoidable risks, which are what are systematic risks. Ladies and gentlemen, let me just simplify this by putting this on a sketch, by putting this on a sketch. We have here, this is the systematic risk. This is the unsystematic risk. And we are saying, ladies and gentlemen, that all investors that are coming to us through CAPM, they will diversify fully. Diversifying fully means eliminating of this unsystematic what here? Risk. So we are only left with systematic risk. So hii ndio uwanja CAPM inapiga mpira. Hiyo ndio uwanja ya CAPM. And then remember very fast that systematic risk is normally measured using beta. It's normally measured using beta factor. Now, ladies and gentlemen, if that is the case, here we are. They would want us to give them the CAPM returns of a security. CAPM returns of a security. Let me see whether there is any student who will be able to write the CAPM returns of a security without looking at the notes. I'm able to see you here, by the way. I'm able to see you all the way from here. Please don't look at your notes at all. Kindly, don't look at, be very honest. Don't look at your notes at all. Just try writing this formula. Even if you get it wrong, so what? Even if you get it wrong, so what? Even if you are to get it wrong, so what? Even if you are to get it wrong, so what? Let me see what we have there. Very good. Thank you very much. Ladies and gentlemen, that was quite a nice one. Most of them have been able to know our base returns. Remember, I call them risk-free. Plus, into brackets, what we have, ERM minus, let me write somewhere where you'll be able to see CAPM returns of a security equals risk-free plus ERM minus risk-free. Now, remember, this is what we call the risk premium. The risk premium has always been multiplied with what here? Risk factors. And our risk factors are what here? Some of the beta factors. So we have beta of a security all over beta of the market. But now remember, beta of the market is supposed to be silent. Why? Because BM is always equal to 1. And if I'm a good scholar of finance, of portfolio management, I know that nowadays, the examiner of nowadays can never give me this figure, can never give me the beta. So I want to see whether we have got only one student who will be able to remember the formula of getting beta J. Beta J equals what? I can choose my students here. Let me start with Bianca. I don't want any other student to write the formula. I want Bianca alone to write the formula for me of getting beta J. There are 2 formulas for beta J. So Bianca, I'm with you, live. Give me the formula. Raymond, that is not correct. Raymond, that is not correct. But thank you very much for trying. Raymond Zhao has picked it up very well. Even Bianca, at the end of the day, Bianca got it very well. Bianca, there is something you've missed. Bianca, there is something you missed. Try to see what is it that you have omitted out. As she's trying to figure it out, can the other students give us the answers here? What is the formula for getting beta J? Marcy has even gone ahead to give me formula 2. The data covariance of JM all over standard deviation of the market squared. 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 So beta J is the same covariance that I showed you up there. So you'll take the covariance between, here you have to relate with the market. Covariance between J and M all over the standard deviation of the market squared. That is formula number 1. How about formula number 2? Like nowadays, the examiner will give you the correlation coefficient. So how do you get beta J? Beta J using the correlation approach. Beta J using the correlation approach. Beta J using the correlation approach. What do we have there? Beta J using the correlation approach. So beta J using the correlation approach. What do we have there? Yeah, Joyce, okay, Virginia. Okay, I can see Raymond there. Peter Kinyumu. No. Duga says R between J and M. Great. Thank you very much. So here, for BJ, what we need to come and do is to take the correlation coefficient between J and M, multiply this with the standard deviation of J, all over the standard deviation of the market, 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 all over the standard deviation of the market. So in our next class, ladies and gentlemen, I expect us to pick it from here, but our next model, our next topic is the one we call very, very famous advanced financing decision. Advanced financing decision has got about four videos. Even if I haven't uploaded them, I know them. About 4 videos. 4 videos. I expect you to take like a week to watch all of them. You watch all of them. Those 4 videos, 2 hours each. Those are 8 hours. And then please, when you are watching these videos, don't watch this as if you are watching this movie of No Retreat, No Surrender. No. You need to watch this thing as if you are in a classroom. You need to have a book, you need to have a pen, a calculator. After some time, of course, for videos, because of editing, because of, we edit to eliminate all the, like these times, I tell you to calculate. I tell you to calculate, of course, I'll have some time lag. So what normally happens in editing will cut that time lag. So you may get the videos moving quite fast. What you need to do, if you need to do any summation yourself, you simply pause. You pause, do calculations, and then now you allow me to go forward like that. You're going to get a very, very good experience. If you look at this thing positively, you're going to get a very, very, very good experience, even better than these live classes. Of course, don't forget that live classes will only be coming once every Friday. So tomorrow's class, use that time to watch these videos. Otherwise, thank you very much. It's been a pleasure hosting you. Good night. Bye-bye. Okay. Now, for the students who are complaining that at times they can't get me, I happen to be having a PA, by the way. I happen to be having a very serious guy who helps me around. If you can't get me, this is his number. Yeah, him is available any time of the day, whether it's 2 a.m. You get him, and then you know what to do to relay the information. Any general questions about how do we, like now the students who are asking us, how do we get accountants being paid? This was a very good debate. Being paid 25,000 a month. Are there really CPAKs who are paid this amount? Are they there? CPAKs who are being paid this amount in the market, are they there? Let me see your comments. Let me see your comments. Are they there? Even before good night, are those people there? And the payment is real. Okay, yes. Trust you me. Most of these people are getting these 25,000 because of what I normally tell them, that they did their CPAs, most of them, but they came out of it without any skill. So they are semi-skilled. They are semi-skilled. They are semi-skilled. Even lower than that. Mwalimu, I thought you would be able to download the videos and watch offline. Yes, there is something we are working on. There is something that our programmers are working on to allow students to download and watch offline. Whatever downloads that we had, we realized we could not protect, we couldn't protect our videos. People could download and then they started doing what you're sharing very fast. So there is something small we are doing, and then we shall be able to have you watching them offline. For now, bundles kidogo. Okay, so we are talking about these 25,000. These 25,000. So they normally get this amount, ladies and gentlemen, because most of them are what here? Semi-skilled. So this is something I'll be able to explain to you. I've taught so many people. Like Joshua Igara, the CEO of KCB, was my student. Right? I've taught so many people. Having done ACCA, I'm a member of ACCA and of course ISPAC. Having done this is a very prestigious course. This course opens your mind. It opens your eyes totally. Having done this course, I know, I can tell you, how comes I have students who are working in this case here for Qatar and they only did CPA, Qatar Airways. How comes I have like another lady that I taught just the other day here, she's the credit controller of breweries, getting over 700,000 a month. Is it because of connections or what? With the survey that I did, and even the kind of people that I interview around, somebody come to my office telling me, Mwalimu, I need a job. I've never gotten a job since we were together in class, wherever, like that. Then I'll just pull something very simple. Even tell them to do a bank reconciliation, they can't. And then they have what? Give them massive data. Give them like an Excel that has got like say 2,000 rows. Tell them even to do simple analytics from there. They can't. They can't. The moment you happen to know, for example, how to use advanced Excel, up to say even 50% alone, trust you me, you will be a brand in the CPA industry. You'll be a brand in the CPA industry. For example, like now, this simple thing that I normally keep on telling you. You're an accountant who only speaks 3 languages. You speak Kikuyu, you speak Kiswahili, and perhaps in this case, you're broken English, right? It can be broken, no problem. But please ensure that you have got like a 4th language, an international language, like Chinese, like French. The moment you are able to translate financial statements here from one language to another, you'll be consulted over by companies like even KRA itself, etc., etc. And these are things, even for example, like advanced Excel, these are things that are there on YouTube. Just go to YouTube, for example, today if you have a laptop. Try to download, for example, materials on simple things. For example, like macros. How do I make use of macros to simplify or rather create, for example, tables that are going to give me information quite easily? These are programming, kind of programming language. How do I work with VLOOKUP? They are very short videos of 5 minutes. You simply get them there, and then they'll even give you data that you use to populate your own Excel. And then you try. Every day, one concept at a time. HLOOKUP, right? The pivot tables, etc. By the time you realize, you'll be able to dissect, to take like information of Coca-Cola, all that information, and then you are able to do this and this. At the end of the day, you will really, really be respected in the industry. And then when you're respected in the industry, you'll command over 2 million shillings a month. That is the time when you come and buy me a Mercedes-Benz, black Mercedes-Benz. Park for me somewhere there, give me the key. Thank you very much. Have a lovely night. Bye. Racism is real. Racism, okay? You'll understand. Having worked for SHA, you'll understand. Thank you very much. Good night, okay? There's a student who is just coming in right now. Let me admit the student. Of course, better late than never, isn't it? Thank you, Virginia. We shall overcome. Of course, I would want to work with you this journey, especially after clearing. After you clear a CPA, that's when I'll be able to work with you in this journey of Excel and etc. For now, we want to clear. Then we have George Getao wants to access those videos. Of course, George Getao, just call that number, 0719 525,000. There's a fees to be paid of 3,400, etc. Bianca says, after clearing, yes, count me in. Very good. We shall be there. We shall be there. When I get that 1.5 million a month, I'll get you the Mercedes. Amen. 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 Don't renege on your promise. Okay, bye-bye.